Fed floats skinny master accounts as limited on-ramp for crypto firms. The Federal Reserve is preparing a limited master account tier aimed at crypto firms, fintechs, and other non-bank entities that have struggled to obtain full access to the central bank's payment rails. The plan, first reported by crypto journalist Eleanor Terrett and amplified by Wu Blockchain on May 20, 2026, would create a stripped-down version of the account product that has historically been reserved for federally insured banks. The idea lands 1 week after President Trump's executive order directing federal banking agencies to review how the Fed evaluates master account applications from crypto-adjacent firms. A White House review of access rules was always likely to produce some kind of structural response from the Fed itself. The skinny account is the first concrete proposal to emerge. A narrower door, not an open one. Master accounts are the plumbing of the U.S. dollar. They let an institution settle directly with the Federal Reserve, hold reserves at the central bank, and tap services like FedWire, FedNow, and check clearing. Without one, a firm has to route through a sponsor bank, which adds cost, latency, and a single point of failure. The skinny version, as described, would carve out a narrower bundle of those services. According to early reporting, the tier is expected to exclude overdraft privileges and may restrict access to discount window borrowing. Some Fed services would be available, others would not. The firm would still touch central bank infrastructure, but on a leash. That distinction matters. A full master account effectively makes a firm a peer of regulated banks inside the payment system. A skinny account would acknowledge that crypto firms and fintechs need direct rails to operate competitively, while limiting the Fed's exposure to entities that do not carry deposit insurance or full prudential supervision. The custodia precedent looms large. The proposal arrives against a long, contested history. Custodia Bank, the Wyoming-chartered special-purpose depository institution founded by former Fed staffer Caitlin Long, spent more than 3 years fighting the Kansas City Fed over a master account denial. That case clarified one thing. The Fed has wide discretion to refuse, and the courts have largely deferred to that discretion. A skinny tier would let the Fed say yes more often without changing the underlying calculus on insured banks. It would also blunt the political argument, currently being pressed by both Wyoming officials and crypto-adjacent lawmakers, that the central bank has effectively built a closed shop. Stablecoin issuers stand to gain most. The firms most directly affected are stablecoin issuers and crypto-native payment companies. A stablecoin issuer with direct Fed access could settle reserves overnight, redeem at par with less friction, and reduce its dependence on commercial banking partners that have at times pulled support without warning. Circle, Paxos, and any future federally chartered stablecoin issuer would be the obvious early applicants. The proposal also intersects with the stablecoin supply hitting a record 323B earlier this month. As issuance scales, the operational case for direct Fed access becomes harder to argue against on technical grounds. The Fed is left arguing on supervisory grounds instead, and a skinny account is one way to split that difference. Fintechs without crypto exposure would benefit as well. Neobanks, payments processors, and non-bank lenders have all faced the same gatekeeping. A tiered structure could be the first time the Fed formally acknowledges a category of almost bank institutions that need rails but not the full balance sheet relationship. Open questions and political headwinds. Several mechanics are still unresolved. It is not clear what application standards a skinny account would carry, whether existing denials could be reconsidered under the new tier, or how the Fed would treat insolvency risk for an account holder without FDIC backing. Pushback is also already forming. Senator Elizabeth Warren has spent the spring arguing that the OCC's National Trust Bank charters for crypto firms violate federal law. A skinny master account product would likely draw a similar challenge, with critics arguing the Fed is creating a backdoor for entities Congress never explicitly authorized to hold central bank reserves. The crypto card industry has a stake here too. Most U.S. issuers currently rely on a sponsor bank to handle card network settlement and dollar custody. A direct Fed account, even a narrow one, would let a payments-focused crypto firm internalize parts of that stack, cutting per-transaction costs and removing one layer of counterparty risk. That savings, if it materializes, tends to surface in lower fees for users of self-custody spending products and tighter spreads on dollar-denominated cards. For now, the proposal is preliminary. The Fed has not published draft criteria, comment windows, or an implementation timeline. But the direction of travel is set. After a decade of treating master accounts as a binary, the central bank appears willing to entertain a second tier.